Okay, so this is an updated training on how to properly calculate unimproved taxes when you're doing new construction. Okay, so it's very important that we understand this process. So if you're a loan partner one, this is important before disclosures go out or before, I would say, the pushing the loan into processing. If you're a processor, it's important to understand when you're getting the loan underwritten, sending the preliminary closing disclosure. If you're a team captain or somebody that's involved in the final CD, that's also important, right? So also as a loan officer, understanding this concept really helps you beat out the competition, because a lot of loan officers do not know how to do this, and new construction is challenging, especially as we head into the back end of the year, where this becomes a bigger issue. So here are some resources to help you. So number one, we have a job aid. Okay. So this was actually something I put together when we were at Summit Funding. So it really helps understand kind of the conceptual stuff if you want to actually read about it. I don't know of any actual training we have at Cross Country Mortgage yet, but the definition of unimproved taxes is basically what are the taxes when it's just land only, right? So if you're buying new construction, the property has not been built yet. Improved taxes are what we're estimating the borrower to pay. Okay, so generally there's rules on this, and this is a little more straightforward, which the guideline on this is you would take the purchase price or the appraised value, which is whichever is higher, 500,000 purchase price, but let's say it appraises for 505. That's very important to know. You times it by 0.8 because that's accounting for a homestead exemption. You do not do that on an investment property or second home. And then you times it by the county tax rate, which you could then, for example, take off the tax certificate if you have it. If you do not have it, then what you could do is maybe look up the actual property taxes. Okay, so tax certificate, you probably look here to find the tax rate, 2.23, right? Total tax rate. So 0.223 is $9,000. Divide that by 12. That would be the amount you would want to put on the processing checklist for your improved rate. So if you're submitting a loan into processing with my team, this is the form that we use. It might look a little different on yours, but you should absolutely be telling the processor what the amount needs to be for the improved tax rate. Okay, so that's $750. That's what it would be when you're buying this property and when it's the home is fully built. That's what we're estimating. Okay, so there's some process workflow here if you want. The main thing here is we need to be able to separate this on two separate lines on the 2015 itemization, and you're going to be putting in basically the unimproved amount here, and you're going to be putting the improved difference here. Okay, so that way you can get this also typically gets broken out here at CCM. It might be a little different. So I would check with your team captain on this, but the total taxes, for example, in this scenario are 500, right? That's the that would be in this example, the 750, right? So you would put 750 here, and then let's say the unimproved amount is more like 100, then you would put the difference here of 650 so you get that difference. Okay. Now, most of the time, I feel like this is pretty straightforward. There's some already trainings on this, but the challenge is like, how do you calculate the unimproved amount? So there are three ways to do that. Okay. So number one is you will go to the county website and you will try to see if they already have a tax certificate or like the tax records on the county website showing that. Okay. So in some situations, they may have that, which would be great. Okay. You're able to like maybe log on to Dallas County Appraisal District and it lists just the address. And let's say it says $500 because it's just land only. Okay. Then you would take that $500 annual figure, divide it by 12, and your unimproved amount is $41 a month. Okay. But let's say you don't get that lucky. And let's say that you have a situation where it's just the entire complex. Okay. So what I would do in that scenario is here's an example on here we go. On the Suresh loan, if you ever want to go and look at that one, is the tax certificate or the tax record showed 43,000. So what we can then do is you look up on the website to see how many units there are. There were 175 units. So then you divide it by 175. That means each individual unit's about $250 per year. Okay. Now let's say there's only 10 properties. Let's say there's 25 properties, whatever it is, you usually can find that on the website or on some of the plan documents. Okay. So then this would be 250 divided by 12. That means the unimproved amount would be 2083. Okay. Now the second way to get that, or that's the second way. The third way is if you have no way to calculate it. If you are in a loan partner one role, you guess. Just put $50 because you wanted to put it as a placeholder. Then what you're going to do is note that on the processing cover sheet, and then the processor is going to be responsible, okay, to basically come back. So this is a good file, Edwards, right, where the processor can, make some notes here. So this is actually a great example, both for Ryan did this one and Grace did this one. So the two of them together did a good job on this, looking at your tax certificate, unimproved taxes, and new construction tax breakdown, right? Then you would put in as a placeholder, right? $50. Then what's going to happen is you're going to wait till we get the title CD. So this is where the processors are coming. So this prelim CD, right? Normally, this is a different example, is you would then take the title CD, you'd scroll down to the bottom of page 3, and you would see this amount here. There should be a tax amount. In this scenario, there's not yet. So we're going to have to wait we're going to wait for the title company to send us that actual breakdown. But let's say they put the tax prorations from the seller at, I don't know, $3,000. Okay. So you see that number 3,000. What do you do with that? Well, the closing on this loan is 8/24, right? So I would do 31 days for the month of January, 28 for February, 31 for March, 30 for April, 31 for May, 30 for June, 31 for July, and 24 days for August. So we have 236 days, right? So 236 days between January 1st and your closing date. So you take 3,000 and you would divide that by 236. And you get to $12 a day, times that by 365 days, which are in a year. 4,639 is what the title company is expecting the tax bill to be at the end of the year. That's why they're prorating it that way. And we divide that by 12. So that means that we would put in the unimproved amount at 386. Okay. And so if you had put in a placeholder, $50, you got to update that. Okay. So that would fall in the processor. So those are the ways I want us to handle this going forward. Hopefully this video is helpful. If not, reach out to me or someone else. Thanks.